Welcome to Blakeley. Well, I'm delighted to say today I've got my good friend Jerome Faury here to talk to us about why a digital society needs a digital currency. So I'm expecting some very astute observations from this man, so let's get going. For you this year, has it lived up to expectations? What do you think, 2019?
Look, I think like many things that are embryonic, it starts with awareness. There's a level of education, a level of understanding, and I think this year was the year where people and businesses and entities became aware of the tsunami of tech and its potential impact on the payments industry to the point it threatens sovereign currency.
Yeah, well, I mean that's quite an insight because let's face it, Bitcoin we all see it as a store of value, but it's not really going to do anything earth-shattering in the payment space. Is it? We're talking 10-minute settlements. We're talking there's a lot of infrastructure out there that can accept Bitcoin, but it doesn't quite do the minimum required for payments technology. No,
I think that 10-minute settlement is fine. I mean, a typical credit card transaction is next business day. So that's significantly more efficient and rapid. Mint bank settlement in most countries isn't yet real time. The challenge with Bitcoin is that the authorization is also, generally speaking, 10 minutes, where a consumer or a merchant in a retail payments environment generally requires an authorization in a few seconds. So whilst it's not as useful for everyday transfer of value, it is a very good store of value. It's a lot more efficient to transfer Bitcoin from here to someone overseas or to do large transactions than it is moving a whole bunch of physical gold or even using bank infrastructure.
Yeah, you've certainly cut to the chase, Jerome. You've quite quickly you've separated the difference between settlement and authorization. That's I guess why our transactions cost so much in a place like New Zealand, where there's no regulation around this, quite a lot. Over 3-4% in some cases. But I guess that's the cost of settlement or cost of authorization that between the two counterpart parties, isn't it? That credit risk they take on, that settlement risk they take on, is the price you pay for speed. And you might have a comment on that, but also you're right to point out that in terms of settlement, Bitcoin and other payment coins, stable other coins, asset transfer or asset coins, tokens, settle a lot faster because that built into the underlying technology, the distributed ledger technology, is once it's settled. Once you achieve finality, that's it. So maybe we could just tease that out a little bit more and where you see the opportunity, especially around that fat that exists around authorization.
I think there's a couple of things. A lot of the fat in the authorization, give or take a percent, is the fund loyalty. That's where a lot of the cost is. There's a lot of various parties running their own infrastructure on the way through a transaction, whether that's a payment terminal company, a switching company, the bank acquiring the transaction, the scheme that uses its network to process the transaction, the issuer of that transaction. They typically all have their own hardware, their own databases, their own ledger, their own support staff, call center staff, business models. The technology itself came out in 1973. A lot of it did. It was enhanced in 1976 with the Visa sort of base 1, base 2 systems. Fundamentally, it hasn't changed that much. I think we've moved from swiping a card to inserting the card to tapping a card, but we still have the card. We still have all of these parties participating in the payment workflow. And the reality is today, the technology makes it possible to have one single ledger of the transactions, which provides real-time visibility, real-time settlement, and I think most importantly, we see a lot of rhetoric around putting consumers in control of their data and open banking. I think there's probably much more elegant ways to do that where the consumer is actually in control of their data, and that's through things like self-sovereign ID, which even if you go to the big scheme websites, so if you go to mastercard.com/identity, they're looking at identity. You look at the tech oligarchs, it's all about identity. How do I use my Facebook or Google ID to sign into some other type of service? And I think people have become aware now of the value of their data and how ID is the gateway to that. And that if you do put the consumer or customer first, then they should have control of that digital identity.
So yeah, mate, so if we boil it down, the transition from electronic funds transfer at the point of sale, or EFTPOS, and the leadership we showed 35 odd years ago in New Zealand, if we're going to transition to this next wave of digital payment experiences that you articulate so well, are you saying it all starts with digital identity? Is that the key to unlocking the promise of open banking and promise of these new technologies, the tsunami of tech, as you put it?
I think so. The digital identity isn't necessarily relating to an individual. My car should have a digital identity. A parking meter should have a digital identity. When both of those assets, things, want to transact, if they have delegated authority from whoever's settling those funds, say me if I'm wanting to pay for the parking via my car, they should be able to do so in a very direct, efficient, harmonious way. Merchants should have digital identities. We should be able to then, on the top of that digital identity, bake in compliance. For example, only two parties, whether that's a person or a person and entity, that have been KYC'd can transact with each other. Only assets which have not come from nefarious backgrounds where we can verify the source of funds from an AML CFT perspective can be transferred once it passes those appropriate sanction tests. You can't do this programmable money, this efficient payment system, without digital identity, because the reality is now money and currency is increasingly becoming more like data than a note or a piece of paper.
Okay, so started with the rise of machines there. So your car's going to have its own wallet. The machines around infrastructure around the city, like parking meters, have their own wallet.
Yep.
You're building infrastructure into businesses. So this is is a wallet like a bank account light, or what is it? It's a viewer to a ledger. I guess, but what's a good way to think about that? Because that seems to be pretty core, that you need to know who is paying and who you're paying to make this increasingly automated transfer of value all function. So that the promise you talked about, faster settlements, compliance built into the transaction or the money itself.
Yep.
What's a good way of thinking about this new infrastructure compared to the traditional banking system, these 30, 40, 50-year-old systems, the core banking systems that we have now, which cost a lot of money. I think the latest figure in terms of overhead from the banks, so this is not the cost of your money, this is just the overhead to run the banks, is about 6 billion in cost plus 6 billion in profit. So a country like New Zealand that GDP is 300 billion is quite a significant 5% chunk going just to keep the system going. Before any money's changed hands.
Great point. So 30% of the bank's cost is in compliance. So I think now with these new digital assets, digital wallets, you can codify compliance within that, and that will make it a lot more efficient. I think wallets.
So you just can't accept the money if it doesn't fulfill certain criteria.
Correct. So for the first time in history, we can now get privacy and transparency. In the past, those things were at opposite ends of the spectrum. However, now...
Paradox, isn't it?
Yeah. It's difficult to get your head around it, but essentially, at the moment, with cash, two people who don't know each other and don't need or want to verify each other's IDs can transfer value.
Yeah. Trustless.
Yeah, trustless, right. So how do you do that in a way that meets KYC, AML, CFT type sanctions in a digital world? And so what we can do now is both parties can be verified by the Department of Internal Affairs or similar as being as KYC compliant. So yes, they've got a valid passport, they're in this country, they aren't on any sanctions or PEP lists. They've been verified to an appropriate bank grade, government grade standard.
Yeah.
Then our wallets have that tick in them. Now the underlying asset itself, if we haven't acquired it through questionable means, and it's in our wallet, then, and I want to send some to you, either using your cell phone number or your unique identifier or otherwise, you don't need to know my name is Jerome, nor do you need to know where my money came from. But what the system needs to know is that both of these parties can be trusted, that they are both legally allowed to transfer value, and that they pass the appropriate minimum standards for compliance in our payments ecosystem.
Sounds like the future of commerce to me, and one that you put so well earlier on. So 2019, if that was the year we became self-aware, both as technologists, but also as the customers of the technology. So the B2B customers, the B2B2C customers. Are the consumers aware of this yet, or is it more the industries the thing that's become aware this year?
I think there's been sufficient compromises with people's data now that consumers are more aware. If you look at the social media compromises, the hotel chains. I know now when someone asks to take a photo of my passport or a system looks for it, I'm less comfortable with that than what I would have been a few years ago.
I think I heard even the Chinese aren't very happy with all the biometric technology and facial recognition that's going on in their market.
Yeah, look, there's a lot of it, but there's ways in which it can enhance the experience and the safety for all in a way which preserves privacy. And I think a lot of that comes down to values, it comes down to frameworks, it comes to a set of general standards that we can agree. But I think, in today's environment, commerce environment, regulatory environment, the hard piece really is how do you remain relevant and keep pace with the world around us, which is increasing in velocity every day. At the same time, managing compliance, managing consumer safety, and being able to make sort of decisions and be decisive, because all of this stuff is happening at such a rate of knots, and the traditional entities that have been the custodians of this type of service and infrastructure aren't currently engineered to operate at the same pace. They're getting a lot of pressure on the compliance side, but equally they're getting pressure on the innovation side. And unfortunately, I think there's an element of discombobulation.
Yeah, do nothing is not an option, and you make some good points around the pace of change. So, I can see that if I look forward to 2020, the squeeze is going to come on. Look at the hospitality industry, and I know we've got some big events ahead to look forward to, which might see us through, but they're going to have a squeeze with the minimum wage going up, local business costs keep going up, rates keep going up. I'm sure if they could get a bit back in the transaction side, that would be a big help. So, you can't just, nothing stands still, does it? You've got to keep looking for opportunity to, or levers to pull, as you put it, to help business along. And then you've got the added benefit of all the data and other benefits.
Correct. The recent report from the Reserve Bank, basically their biggest issue is they have little to no visibility over the money supply. They can print or distribute more dollars into the market, but does that dollar get converted to US dollars? Does it sit in the bank not doing anything in a vault? Does it go to buy a house, or does it make it down to the corner store for people to buy their food or veg, right? they don't have any, well, they've got very limited visibility.
Yeah.
Once you've got something that's digital, then you can actually see what's
See the
going on.
basket. Yeah.
Well, you can make decisions based off data, and that will help with policy, and that will help with economic well-being of this entire country.
So it sounds like we're going to see some interesting moves around digital identity, potentially digital currency in the new year. Hopefully in the next 12 months, if the global noises come true. If you're a investor looking to make an investment in this kind of new technology, where would you look? Would you look on the token side, Bitcoin, security tokens, utility tokens, or would you look at potentially joining an investment club and trying to invest in a startup that's doing some cool stuff in this space?
Yeah, look, I've got a few answers to that question, but one of the ways I've been thinking about it lately is looking at who has the most to lose out of this potential disruption. So who are the incumbents that currently handle cash, that print money, that provide that have the relationships with the banks, the Reserve Bank, and those types of entities. And then out of those parties, which of the ones have already identified the risk to their business model and have started the journey to adapt and transition from your physical monetary system to a digital one. And I think for me...
Who are you talking about?
Well, I'm not going to name specific names, but yeah.
You're talking about infrastructure companies, software companies?
Yeah, or even security companies that pick up cash from one bank, move it to another bank.
Yeah.
Companies that provide vaults to banks.
So you're talking about more of a traditional security type investment, maybe an equity play on the share market, or looking at companies that are in this space who can...
I'm thinking more services. Service providers, yeah.
Service providers. So how does a retail investor or even accredited investor get access to some of those opportunities?
Oh, look, you got to do your research. Yeah, definitely do your homework. It's just an idea I had recently when looking at what was going on in the market is who has the most to lose, and which of those ones have put themselves in a position to adapt the best. The ones that aren't ready to adapt or don't have the ability to do so are going to struggle in the future. The ones that can evolve, that can capitalise on this systemic and material change, arguably a once in a lifetime kind of change. Like the note is 1,000 years old. Those are the ones that I think will be interesting in the future.
All right, mate. I think that's a good place to leave it. The once in a lifetime opportunity. You heard it here first on Blakeley. Thanks, Jerome. Appreciate it, mate. Thanks for coming by.